Welcome to The Educated Trader, where we unravel the mysteries of investing and help you to make educated decisions. In this video, we're diving into an essential topic for every investor: asset classes. You might be asking yourself, what exactly are asset classes? Simply put, they're the fundamental building blocks of any smart investment portfolio. You can think of them as different groups of investments that behave similarly in the financial world. Each group carries its own level of risk and potential for return, reacting uniquely to changes in the economy and markets. Probably, these definitions don't mean a lot to you just yet, but don't worry. If you're just getting familiar with the world of investment, or if you're trying to understand how things work, stay tuned. You've come to the right place. Before getting a better idea of what asset classes are, we need to look at some basic yet important concepts. These concepts will help us differentiate asset classes. The first one is investment return, or simply return. Let's assume you buy a company you believe will do well for $1,000. After 1 year, the value of your company rises to $1,100. Those extra $100 you made are your investment return. In percentage terms, which is usually the measure of return, it is 10%. That's because your investment grew by 10% of what you originally put in. It's a way to measure how well your investment did. Return can be positive or negative. If the value of your investment had gone down to, let's say, $900, your return would be represented in negative numbers as negative 10%, showing that you lost money. The next concept we have to understand is volatility. When an investment is described as volatile, it means that the price of that investment, such as a stock or a commodity, can change rapidly and unpredictably over a short period of time. It's like a roller coaster ride with a lot of ups and downs. For example, if you buy a stock and its price jumps up and down a lot over a few days or weeks, that stock is considered highly volatile. It's important for investors, especially beginners, to understand volatility because it's a form of risk. One day your investment might be worth a lot, and the next day it might drop significantly. High volatility means higher risk, as your investment's value can change dramatically in a short time. Meanwhile, low volatility means the price doesn't change as dramatically, which is typically seen as lower risk. Lastly, we need to look at liquidity. Liquidity in investing terms means how easy it is to turn something into cash. Imagine you're at a sports event on a hot, sunny day with bottles of water. Everyone's thirsty, so you can easily sell your water for cash. Just like having a liquid asset in finance, you can quickly sell it at a set price, and your good, which is water, doesn't lose in value. Now, instead of a water bottle, think of a huge, fancy art sculpture. It's valuable, but finding a buyer who wants it and agrees on a price might take time. That's an illiquid asset. It's harder to sell quickly without losing value. So, liquidity is all about how fast and easy it is to turn an investment into cash. It's crucial because sometimes you need quick access to your money, and knowing the liquidity of your investments tells you how fast you can do this without losing value. With these concepts in mind, we're almost ready to dive deep into the world of asset classes. But before we do, remember that the time frame you consider will also be crucial. It'll impact the returns, volatility, and liquidity of your investments. Now that you're familiar with the essential concepts to differentiate asset classes, it's time to look at the first asset class, equity. This asset class is about stocks. When you buy stocks, you're basically snagging a piece of ownership in a company. Let's say there are 100 shares in a company, and you grab one. You now own 1% of that company. With that stock in your portfolio, you can start making money, and there are two main ways to do so. First, if the stock value goes up, you can sell it for more than you paid. That's called a capital gain. Second, since you're a partial owner, you might get a slice of the company's profits, called dividends. If the company rakes in $100 in profit and you own 1% of the shares, you could pocket a dividend of $1 or so. Sounds like a great way to make money, right? But hold on tight because stocks can be a wild ride. They are known for their volatility. Remember that word? Yes, stocks are volatile because their prices bounce around like crazy, and it's due to things like how the company is doing, what people think about it, economic twists and turns, and even global events. However, stocks can also be quite liquid, since sometimes they're pretty easy to turn into cash, especially if they're traded on the big stock exchanges. Stocks from big, well-known companies, which we'll call large-cap stocks, are usually easy to buy and sell. On the other hand, smaller, lesser-known companies called small-cap stocks might not be as quick to cash out, so they're a bit less liquid. Over time, stocks can bring in some serious cash. Take the S&P 500, for example. It's like an ultimate team made out of the 500 biggest U.S. companies. Investing in it over the last decade would have scored you more than a 12% return each year. But remember, those high returns come with a more elevated level of volatility, which needs to be considered as well. When it comes to investing in stocks, you've got choices. You can go all in on individual companies you think will be successful, kind of like betting on the next Microsoft. But that takes time, know-how, and a deep dive into the company. Alternatively, you can hop on the stock fund train, a bunch of different stocks bundled together. Some are managed by pros, others just follow an index like the S&P 500. It's like a buffet of stocks. It gives you a variety and spreads the risk. Less stress, more diversification. However, with a stock fund, you don't pick individual stocks, and the potential for high returns might be lower compared to successfully picking individual stocks. So, which path is right for you? Well, it depends on your style, your risk tolerance, and how much time you've got to spare. Some people love the thrill of picking stocks, while others prefer a hands-off approach with a stock fund. Overall, when you're eyeing the stock market, especially in the US and Europe, you can remember that your expected return, compared to other asset classes, is generally moderate to high, which also applies to the volatility you may encounter. But the respective stocks are usually very liquid, making it easy to get your hands on when you need them. The next asset class is fixed income, which is all about bonds. When you invest in bonds, you are basically lending your money to a government or a company. In return, they pay you interest, usually a couple times a year. And when the bond matures, you get the money back you originally lent. It's like having a reliable income stream you can count on. When you're in the bond game, it's crucial to check out the creditworthiness of whoever you're lending to. Think of it like a report card for how likely they are to pay you back what you've invested plus interest. Credit rating agencies like Standard & Poor's, Moody's, and Fitch rate these issuers to help you figure out the risk. Bonds with higher credit ratings ranging from BBB- to AAA rating are seen as safer, low-risk investments. On the other hand, bonds with lower ratings, including BB+ and below, carry more risk but offer juicier returns. Compared to stocks, bonds are generally seen as less risky. They're perfect for people who want to play it safe and keep their investments stable. Plus, they're pretty easy to buy or sell, especially the government or top-notch corporate ones. Now, let's talk about returns. The money you make from bonds depends on a few things: interest rates, the credit quality of the issuer, and how long you're in it for. Higher risk or long-term bonds might offer bigger returns, but they come with a bit more risk attached. Overall, bonds usually give you better returns than parking your cash in a savings account, but not as much as diving into the stock market. Just like with stocks, you've got options with bonds too. You can go all in on individual bonds if you are eager to take the time and do some research, or you can play it safe with a bond fund, a mix of different bonds that spreads out the risk for you. Less stress, more diversification. To sum it up, when you're thinking about bonds, especially in the US and Europe, expect low to moderate returns, and the same applies to their volatility and liquidity. They might not be as thrilling as stocks, but they're a solid choice for anyone looking to balance out their investment portfolio. Plus, bonds are traded over the counter and not via a central exchange. The next asset class to learn is cash and cash-like investments, the safety nets of the investment world. When we say cash and cash-like investments, we're talking about things like U.S. Treasury bills and money market funds. They're known for being easy to convert into cash and very safe. This makes them a good choice for investors who want to keep their capital safe and need quick access to their money. These investments are steady as a rock. They don't ride the ups and downs of the stock market, so you can sleep easy knowing your money is safe. This means that they have extremely low volatility. It's like having cash in your wallet. You can grab it whenever you need it without worrying about its value changing. However, the flip side of all this safety and convenience is that cash and cash equivalents usually have low returns. They tend to just keep up with inflation. So, while they're great for keeping your money safe and readily available, they're not exactly designed for making it rain. It's all about striking that balance between safety and growth in your investment strategy. Now, let's move on to the asset class of real estate, one that most of you are probably familiar with. Investing in real estate is pretty much about putting your money into properties, houses, offices, maybe even a nice warehouse, and hoping to cash in down the line. How? Well, by earning rent and hoping for that property value boost. Commercial real estate, such as office spaces and malls, makes a profit through leases, while residential spots pull in the money with rent. Properties can go up in value over time thanks to things like location, demand, and economic growth. So when you sell, you could be looking at some serious cash in your pocket. Real estate is also seen as a way to protect against inflation. This is because property values in rental homes usually rise when general prices do, helping to maintain the real value of your investment. But real estate also has its downsides. Owning property means dealing with the nitty-gritty stuff, keeping it spick and span, dealing with tenants, and navigating all the legal stuff. You can roll up your sleeves and do it yourself, or hire a crew to handle it for you. Real estate's value depends on the economy, interest rates, and what's currently happening in the local market. During an economic downturn, property values might take a hit, but when the economy is booming, you'll likely see a surge in demand. Just like in stocks and bonds, investors can also gain exposure to real estate without direct property ownership by investing in real estate investment trusts, short for REITs or real estate funds. They're like cheat codes for diversification and liquidity, perfect for the investor who wants a slice of the real estate pie without all the hassle. Overall, real estate is seen as offering moderate to potentially high returns. This comes from rental income and possible increases in property value. Real estate investors might also enjoy certain tax benefits, like depreciation deductions, and this asset is generally less volatile than stock, which, now you know what that means, its value doesn't change as quickly. However, it's also a more illiquid asset, meaning it's a bit sluggish when it comes to buying and selling. Why? Because selling property takes time and resources, so you can't exactly just sell it when you want to. This lack of liquidity can make it harder to react quickly to market changes. The next asset class we'll consider is commodities. Here we cover the basics, things like gold, crude oil, and all those agricultural products you can invest in. Many investors add commodities to their portfolios for diversification and protection against inflation. However, investing in commodities comes with its own set of characteristics and is often, unless you are a property commodity trader with adequate logistics, done via derivatives. Commodities can have good and bad times. Sometimes they go through super cycles where their prices shoot up, giving investors big profits. But just like any investment, commodities can also have times when they don't do so well. One important thing to know about commodities is that they can be very volatile. Their prices can change a lot very quickly because of things like what's happening in the world economy, politics, and how much of them are available. For example, the prices of things like oil, gold, and food can go up and down a lot more than the prices of stocks or bonds. And when it comes to liquidity, it looks different for different commodities. Some commodities, like gold and oil, are easier to buy and sell because lots of people trade them. But others, like some kinds of food, are harder to trade quickly because not as many people are buying and selling them. Now, let's explore a relatively new asset class, cryptocurrencies. Cryptocurrencies are renowned for their potential to yield high returns. Take Bitcoin, for instance. Its value has skyrocketed, turning early investors into millionaires. Yet, the crypto market remains notoriously unpredictable, with past successes offering no guarantees for the future. While some have profited immensely, others have faced substantial losses, particularly in short-term ventures. So, regarding volatility, cryptocurrency prices can fluctuate dramatically within short periods, presenting opportunities for significant gains or losses. On the other hand, liquidity varies among cryptocurrencies. Major ones like Bitcoin and Ethereum boast high liquidity, facilitating easy buying and selling on the exchanges worldwide. However, smaller or newer cryptocurrencies may lack liquidity, complicating large trades and rapid conversions to traditional currencies. Overall, cryptocurrencies promise high returns, but they also entail significant volatility and liquidity variations, which makes them risky assets, demanding careful assessment of investment objectives, risk tolerance, and portfolio allocation. Finally, the last asset class we'll be looking at is alternative investments. They include things like hedge funds, private equity, art, and collectibles. These investments help diversify a portfolio, meaning spreading out investments to lower risk. One thing about alternative investments is their potential for lower short-term volatility. They might have fewer ups and downs in the short term compared to stocks, but this can change a lot depending on the market and how the investment is managed. For example, some hedge funds try to keep things steady, while others take bigger risks. When it comes to liquidity, it might be harder to get your money out of alternative investments quickly. Some, like hedge funds, might tie up your money for a while, so you can't sell it fast if you need to. However, this can vary significantly depending on market conditions and the specific strategies used within each alternative investment. The returns you can expect from alternative investments can be very different depending on what kind of investment it is. Private equity and venture capital can bring in big returns, but they come with big risks and might take a while. Hedge funds might not bring in as much, but they aim for steady returns that don't follow the stock market's ups and downs. Overall, alternative investments have their own unique features, including different returns, risks, and liquidity. They can help spread out risk in a portfolio, but you need to think carefully about how they fit with your goals, how much risk you're okay with, and when you might need the money. And there you have it. These are the major asset classes that you can invest in, and with their inherent characteristics, you have understood an important building block on how to become an informed and seasoned investor. Remember, successful investing isn't just about knowing each asset class. It's about smartly blending that knowledge to reach your investment goals. Keep learning and exploring our other investing guides to further enhance your understanding and make informed decisions that align with your financial objectives. See you next time.